We saw those debt yields going through the roof. We saw demand actually picking up for T-bills. Overall, what does it mean for the Treasury 10-year?
In the short term, probably still a bit cautious. If we get to 3%, I don't think at this point people would be too surprised. I think we need to have a slightly longer term perspective. Do you think, number one, inflation expectations can really rise much further than they have already? We think probably not. You've, of course, got the concerns about the increase in issuance because of the budget deficit and, of course, balance sheet runoff. Offset that with global demand for treasuries, be it from China, be it from European investors. So in the balance of all of that, for us, is actually yields going lower from here to the end of the year as opposed to higher.
Okay, what does it mean for Fed rate hikes? 3 or 4 further? The word of the hour is not Tom Keene, Tom. It's further. What does that mean?
It seems so innocuous. We're expecting 4 this year. We already had thought there was going to be 4 when it was just the tax cuts. Now you've added another $300 billion around the debt ceiling deal. So it just does seem fairly clear that the Fed is aware of this. It knows fundamentally, and this goes back to the chart that we showed about U.S. GDP, the U.S. can't grow at 3% without generating too much inflation. So the Fed sees that. It's going to raise rates to make sure, in a sense, that that doesn't happen.
Do we see that inflation yet?
We only had one number, of course, so far for payrolls. Even with the jump that we did see, of course, it's still well below what a Taylor rule would tell you, meaning where unemployment is, where you think wage gains are. So there really should be more to go there. Within the economy, you do and you don't. If you take the CPI figure that we had last week, on a 3-month basis, the annualized inflation rate for core CPI was 2.9%. So you're already well above the Fed's target. So it is there. It is moving up. But I think really the issue for the markets, for fixed income, for equities, it's not so much inflation rising. That's a good thing. We want that. It's the fear that it suddenly accelerates and you're going above 3%. And we still think the likelihood of that is pretty low.